All right, let's dive right into this. Welcome to today's Explainer, where we're going to put Camden National Corporation through what I like to call the Guru Gauntlet. We are basically going to evaluate this regional bank using the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous intrinsic valuation models. If you're looking for a masterclass in objective stock evaluation using nothing but the hard data, you are absolutely in the right place. So here's our roadmap for today's analysis. First, we'll do a quick company snapshot. Then, we'll view the stock through the Buffett lens, the Lynch lens, and the Graham lens. After that, we're going to run a DCF and some alternative models. And finally, we'll wrap it all up with our synthesis and our final call. Okay, part 1, the company snapshot. Let's establish our baseline. $7 billion. That is a massive number, and it represents Camden National's total assets, which actually makes it Northern New England's largest publicly traded bank holding company. Founded way back in 1875, this is a deeply entrenched, historically established institution with 72 banking centers spread across Maine and New Hampshire. Let's break down the core financials real quick. Trading under the ticker CAC at around $59 a share, Camden just posted a record second quarter net income of $23 million. That pulls in a very impressive $1.35 per diluted share, and you can really feel their momentum right now. That record quarter was driven directly by expanding their net interest margins and a massive 21% sequential jump in non-interest income. Looking ahead, analysts project their full year 2026 EPS to hit $5.40, which marks a roughly 23% growth rate. With baseline numbers that solid, it really makes you wonder, what exactly would the Oracle of Omaha himself see if he looked at Camden National? Which brings us to Section 2, the Buffett lens, moats and owner earnings. Now, we all know Warren Buffett focuses heavily on economic moats, incredibly consistent earnings, and manageable debt. So the trick here is weighing those qualitative strengths against the natural risks of the business. On the strength side, Camden boasts a really robust 12.92% return on equity and a massive 18.47% return on average tangible equity. Plus, they have a remarkably sticky core deposit base, which is a classic Buffett moat, and excellent expense management highlighted by a non-GAAP efficiency ratio of 53.23%. But on the risk side, their loan growth is just moderate, and like literally any regional bank, their fortunes are heavily tied to the local New England economy. Now, Buffett loves to look at what he calls owner earnings, essentially the true, actual cash flow available to the owners of the business. If we take Camden's record Q2 net income of $23 million and annualize it, we're looking at roughly $92 million in approximate owner earnings for the year. To put that into perspective, for a bank with a market cap sitting just shy of $1 billion, that is a seriously consistent cash-generating engine. But here's the catch. Buffett never overpays. Never. If we assume their intrinsic value is somewhere in the low 70s based on those owner earnings and we apply a conservative 25% margin of safety, that gives us a target buy price of around $55. Given that the stock is currently trading closer to $59, Buffett might love the business, but he'd likely just sit on his hands and patiently wait for a slight pullback to hit his strict margin of safety before making a move. All right, so Buffett is holding out. But what about the absolute champion of growth at a reasonable price? Would Peter Lynch buy this bank? Let's move to Section 3, the Lynch lens, categorization and PEG. Lynch famously liked to categorize stocks into distinct buckets, and Camden National is a textbook stalwart. It's a large, historic entity that offers moderate, steady growth over time. Stalwarts are actually famous for providing excellent dividend protection during economic uncertainty, and Camden definitely delivers here. They have an uninterrupted dividend yielding anywhere from 3.10% to 3.57%, depending on the exact daily price, and that is backed by 30 consecutive years of payouts. But the real magic for Lynch always happens with the PEG ratio. He absolutely loves a PG below 1.0. Camden's forward PE is a very affordable 10.94, and thanks to their recent earnings acceleration, their projected FY26 EPS growth is sitting at about 23%. So you divide 10.94 by 23 and boom, you get a PEG ratio of 0.47. In Lynch's system, a PEG of 0.47 isn't just good, it indicates a highly attractive valuation. Combined with their strong balance sheet and those well-covered dividends we talked about, Lynch would very likely categorize CAC as a strong buy at today's price. So Lynch is clearly a fan, but let's bring in the ultimate conservative quant. Does this stock survive Benjamin Graham's famously strict tests? Section 4, the Graham lens, running the defensive checklist. Graham's defensive checklist is notoriously tough to pass, but Camden just breezes right through it. Adequate size? Yes, $7 billion in assets. Stable earnings? Absolutely, we just saw that record net income. Uninterrupted dividends? Yep, currently paying out $1.68 annualized. Moderate PE? Yes, 10.94 is well below Graham's strict upper limit of 15. The underlying financial condition here is just incredibly solid. Then we get to Graham's famous intrinsic value formula, which demands strict conservatism. You take the square root of 22.5 times the earnings per share, which is $5.40, times the book value per share. And actually, we use tangible book value here, which is $31.64, just to be extra conservative. Do that math, and it yields an intrinsic value of approximately $60. Now, since the stock is at 59, it is technically undervalued by Graham's formula. However, Graham demanded a massive margin of safety, meaning he probably wouldn't actually trigger a buy until this stock dropped much closer to $50. Section 5. DCF and alternative models, the math behind the value. Moving away from the gurus, let's just crunch the raw numbers. To build a base case discounted cash flow model, we have to lay out our assumptions. We're using a 10% weighted average cost of capital, which is a pretty standard discount rate for regional banks. We assume a 5-year forecast period with moderate cash flow growth and a conservative 2.0% terminal growth rate. Run all that through the model, and our base case DCF yields an implied fair value of exactly $64 a share. But you know how these DCF models are. They're incredibly sensitive to whatever assumptions you feed them. So looking at a sensitivity table is absolutely crucial. If the cost of capital drops to 9%, the fair value jumps all the way up to $71. But if risk increases and we use an 11% discount rate with a lower 1.5% growth rate, the fair value drops down to $57. So the math tells us the true value solidly sits somewhere in that $60 to $65 range. Just to cross-check that, we applied 2 alternative models. Because Camden pays such a strong, consistent dividend, the dividend discount model is highly relevant here. Using that $1.68 annualized payout, the DDM gives us a fair value of $60 flat. Furthermore, if we look at analyst consensus for comparable PE multiples, the average price target sits right at $59.50. Notice a pattern? Everything is converging right around this $60 mark. Which brings us to our final section, number 6. Synthesis and final call. Let's bring all the pieces of this puzzle together. The data really tells a fascinating story here. Buffett's framework finds great underlying value but demands a wider margin of safety, giving us a buy target under 55. Lynch loves that PEG ratio and would gladly buy anywhere under 60. Graham's formula values it at 62 but requires a very deep discount, targeting under 50. Meanwhile, our DCF and our alternative models all point to a fair value clustering tightly between $59.50 and $64.50. So what is our final verdict? Blending all of these insights together, we are initiating an objective hold rating at the current price of roughly $59.07. Make no mistake, the company's strengths are undeniable: a nearly 13% ROE, an incredibly cheap 0.47 PEG ratio, and record earnings. However, the stock is currently trading right at or just slightly below its fair intrinsic value. That leaves a very slim margin of safety against normal regional banking headwinds and discount rate sensitivities. It is a fantastic company for sure, but disciplined value investors might want to wait for a slight dip. Which leaves me with one final question for you. Based on all this data, what price would actually trigger your buy?